Hey investor friends, I'm Michelle Markey and today I'm going to talk with you about employer-sponsored retirement plans. And some of these include things like 401k plans or pension plans. And then if you're self-employed, you have a few other options like a solo 401k or a SEP IRA or a simple IRA. And I'll get into more details behind what each of those things means and what some of the acronyms stand for. And in my case, I've had both 401ks and SEP IRAs before from my employers, but I haven't had a solo 401k or a simple IRA. So some of that I just did some research in, but I have some comparisons to draw from between all of these kinds of plans. In my 401ks, I've had a few options as to where I can put my money, and some of these include a short-term fixed income fund, as well as small cap, mid cap, large cap, international and emerging equity and bond funds, among other kinds of mutual funds that you can invest in a 401k. But these are the main options that at least I've seen in my 401ks. Some of these could be a little bit different depending on the provider of the 401k plan and depending on what your employer chooses to provide as an offering to you. But in general, you usually have access to something called target or life cycle funds, which are mutual funds based on the year in which you plan to retire and based on factors of allocating funds towards stocks or bonds depending on which life cycle target date you choose. You can invest in something like that, and that's what actually a lot of 401k plans default to if you contribute the minimum to get a match. And that's what you could be just placed in if you might not choose. You could choose other kinds of funds that you want to be in, but one of the more common ones is a target, let's say index fund or mutual fund that you could invest in your 401k. To add a little bit more detail behind some of the kinds of funds available in a 401k include in the short-term fixed income fund option. That's kind of like a cash vehicle that invests in short-term funds like money market funds or bonds, and you usually expect a low interest rate. For example, 1 to 2% you could expect to generate in something like that. And short-term fixed income funds are usually considered kind of like a guaranteed fund. Not always, but they kind of treat it like a cash annuity where you get kind of a fixed amount of income in that fund. So that's one place you could put your money in a 401k, and it generally won't have high returns. And then other possible funds that might have higher returns include things like bond funds, which are slightly higher than the short-term fixed income, or there's also stock-based index or mutual funds that can have a range of returns. So you could even go negative on return rates in these sometimes, but usually one would hope that you would earn a positive rate of return on the stock-based funds. So in the stock-based funds, you could have a range of combinations with active money managers combining small cap, mid cap, and large cap funds, or international or emerging market kind of equities into whatever kind of fund is set up and offered in your 401k plan. And to explain a little bit behind the market capitalization, if it's a small cap, it's between a market price valuation of $250 million to $2 billion for that particular company stock. And that's based on the share price times the total outstanding shares in that company stock. So if you invest in a mutual fund that invests in the Russell 2000 index, that is basically taking share of all of the small cap companies, up to 2,000 of them in the Russell 2000, and making a mutual fund based on the small cap stocks in that index. And then you have mid cap stocks, which range from 2 billion to 10 billion in individual company market cap. And then you have the large cap stocks of 10 billion or more in individual company market cap. So you could have a bunch of funds that invest in varying degrees of these companies. You could have a index fund dedicated only to large caps like the S&P 500, where you're invested in 500 large US stocks. And then You could have, like I said, various combinations of these, as well as you can invest in international companies or emerging markets. Regardless of which kind of mutual fund you choose in your 401k, there are a few things that I would pay attention to, one of which is the expense ratio. So you want to look for a fund that charges the lowest amount of expense ratios, like ideally like 0.03% or less. But often a lot of 401k funds tend to be higher. Sometimes they're anywhere from 0.3 to 0.7% or even 1 to 2%, which is kind of a lot. So I'd be mindful about those kinds of expense ratios, as well as look at the historical performance of these funds and also compare them to some of the popular benchmark indices like the S&P 500 or the Russell 2000, depending on the performance of these large and small cap indices respectively. And then see if the composition of the funds that you're investing in reflects kind of some of the market trends, and if you want to be invested in something like that in the near future. So let's say a small cap type of fund has been performing well until recently, and it's been on the downturn for some months or years, and you have to think about, do you want to invest in that kind of fund right now when maybe it still might be going down, or maybe it's starting to go back up again, so maybe now is a good time to rebalance or reallocate your 401k funds into an index or mutual fund like that. Since our main 401k options are usually these diversified funds, we can't really drill down into some of the specific companies sometimes to really know if those are the kinds of companies or equities or bonds that we really want to be invested in. So you just try to do the best you can to look at the historical performance, and although it's not a guarantee of future performance, it gives you some idea of how some of these funds have been performing and if it's something that you personally want to be invested in. And in my case, I'm not really trusting the market right now in October of 2020. Some of the markets have been at all-time highs, and I personally right now don't feel very comfortable investing in some of the various cap funds or even target funds. So I'm keeping some of my money right now in just the cash equivalent, guaranteed, or short fixed income kind of fund, because that's the next best place I can put it right now. But maybe when the markets start going down and some of the companies within some of these funds are a little bit cheaper, maybe that's when I'll reallocate some of that money to one of the stock-based funds, so that when the markets recover and they start going back up again, I can take advantage of that. So that's what I'm doing. I'm not saying that you need to do that, but that's just what my comfort level is. And that has nothing to do with if I'm risk averse or not. I actually have a stomach for wanting to invest in stocks, which some people might consider risky, but I don't fully trust investing in a diversified fund that I don't really know or necessarily understand all the companies that are within a diversified fund. So that makes me feel a little bit less comfortable investing in them, knowing what I know and how my personal preference is to invest in individual stocks if I had the choice. And before we get into details as to what each of these kinds of 401k or other employer-sponsored plans will entail, I also want to note, if your employer offers any kind of match, you should definitely take advantage of that, because it's like bonus savings that you may not otherwise have had the opportunity to save towards your retirement. So let's say you're earning $60,000 and the minimum in order to get a match to set aside into a 401k is 5%. So if you're earning $60,000, that's $3,000 at minimum that you have to contribute on a pre-tax basis, or you could probably also have an after-tax basis if you do a Roth 401k. But let's go with the pre-tax option for now. So if you're contributing $3,000, then your employer matches that same amount, that same 5% that you contributed of your salary, and then contributes another $3,000 for a total of $6,000 that will be in your 401k and is available to invest. And you usually get that in a bi-weekly paycheck if that's the cadence in which you're paid. And you get that split across the 26 pay periods in a bi-weekly paycheck cycle. So whatever 3,000 divided by 26 paychecks is, that's the amount that gets contributed each paycheck, and your employer matches that amount. To provide more details, I compiled the following information to serve as employer-sponsored retirement plans that are available for employees, and also on another slide, what's available for self-employed persons or small business owners. So first, starting with what's available for employees most commonly. There's the 401k, which is a defined contribution plan, compared with a more traditional pension, which is a defined benefit plan. And the maximum yearly contributions you're allowed to a 401k include up to $57,000 if you're under 50, or $63,500 if you're over 50, as part of catch-up contributions that you're allowed to make. And pension contributions can vary depending on the years of service and the employee's age and salary, depending on what the pension plan that has been set up at a particular organization. And commonly, a lot of the public sector or government tends to provide pensions, although there's still some private sector pensions that are available for people. So it's not as common to see pensions in the private sector. Like, a lot of for-profit companies tend to offer 401ks, but that's definitely an option that people can have in some companies, or usually government institutions like the federal, state, and city government, and other kinds of government agencies tend to provide some level of pensions, as well as they also provide 401ks. And one of the key differences between a pension and a 401k is the retirement expectation. So you have certainty in a pension where you have guaranteed periodic payments, considered a life annuity, and or lump sum payouts in retirement. And you get this unless the employer goes bankrupt, if it's a public company, and or if they place a freeze on the pension. And typically you're not going to usually face this kind of a freeze on a pension from a government type of agency. You're more likely to have the pension continue if you work for a government agency. However, with a 401k, you have no certainty. There's no guarantee that you'll get any money paid out to you during retirement, because depending on what you're invested in, some of your 401k investments could be in stocks, bonds, it could be in all kinds of funds where you could still lose money. So that's why it's called a contribution plan, because you as the employee need to contribute to your retirement, whereas with a pension, you're just given the money from the employer. They entirely sponsor and fund pensions based on some of the factors I mentioned earlier, like salary, age, and years of service to the organization. However, even though you have to contribute as an employee in a 401k, which can be up to $19,500 if under 50, or up to $26,000 if over 50 per year, you have the potential to get a match from the employer. So your employer could choose to match 1-to-1, or more or less than that. Some I've heard can match up to 3-to-1, or some amount similar to that or less, and some don't match at all. And with the 401k, you have certain kinds of funds you can invest in, like I mentioned earlier, whereas in a pension, the employer has hired a fund manager to do the investing. So you, as an employee, neither contribute nor do you manage the funds in a pension fund. That's one of the key differences to keep in mind, as well as if you're in a pinch and need to be able to loan from your 401k, you're able to do so, whereas you wouldn't be allowed to do that or take early withdrawals from a pension fund. So at this time, I'd like to give you a few moments to pause the screen and read some of the notes below here, because I tried to compile some of the more relevant types of information in reviewing what your options are if you're in a 401k and or in a pension plan. And I definitely encourage folks to read more. I just happen to put this type of information into the table in front of us. So I'm going to move on to the self-employed and or small business owner options with a solo 401k, a SEP IRA, also known as Simplified Employee Pension IRA, and a simple IRA, which stands for Savings Incentive Match Plan for Employees. So I know that was a mouthful. And you can see right away with a solo 401k that it's very similar to what you can do in a 401k if you were an employee of an employer. But here, when you're your own boss and you have no employees except for a spouse also in the business, so in a solo 401k, you are both the employer and the employee. And as the employer, you can contribute up to 25% of employee salary or 20% of your business earnings or net self employment income. And the figure of $285,000 is a limit used in the calculations as to what can be contributed in total to a solo 401k. And then your contribution as an employee is allowed to be like a 401k in the example before, 19,500 if under 50 and then up to 26,000 if over 50 or doing catch-up funds. And these can be contributed both as pre-tax and or after-tax dollars depending on how you want to do that split. And you'd probably want to contribute in after-tax or Roth dollars if you think that you'll be in a higher tax bracket when you're in retirement. So maybe right now you're in a lower income tax bracket and contributing after tax dollars right now makes sense. Or if you think that you'll be in a lower tax bracket in retirement, you might want to contribute pre tax dollars. So those are some of your options with the 401k. But the difference between this solo 401k and the previous one I talked about as an employee of another employer, not yourself, is that you might have more flexibility in a solo 401k to invest in things like stocks, bonds, both index mutual funds, ETFs, and other assets like real estate. And you actually see that across the board here with the SEP IRA and simple IRA as well. This is a bit of a difference from the 401k before, where you can only invest in limited kinds of funds. And then if we compare the solo 401k to the SEP IRA, you can see that it's kind of similar. It's also a small business, but has very few employees. So it's more than just you and your spouse. You might have maybe 3 to 5 employees. And here, the employers can also contribute in a similar way as in the solo 401k on a tax deferred basis only. So the thing is, you wouldn't be able to contribute any Roth dollars in a SEP IRA. And also, if you notice a difference of the maximum total that you can contribute is 57,000. So there aren't any catch-up funds of another $6,500 if you're over 50. That's just not an available option. But at least as an employee, you're 100% invested in whatever your employer contributes. So you as the employee don't have to contribute. And the other difference is you can't loan from a SEP IRA. So that's one benefit that you might have in a 401k is that you can still loan from that solo 401k, just like the original 401k. And then when we look at a simple IRA, this has the least amount of contributions per year as an employee. You can contribute pre-tax up to $13,500 if under 50 and up to $16,500 if over 50, and you also don't get a Roth option here. So similar to the SEP IRA, you also can't loan from it, and it has a few nuanced differences from the SEP IRA. So in the simple IRA, the employer is able to match employees' contributions dollar for dollar up to 3% of the employee's salary or contribute a flat 2% of the employee's salary. And again, like the other examples here, a $285,000 limit is used for calculating the amounts that you can contribute. But in this situation, the simple IRA may not be as an aggressive means of contributing to a retirement plan as the SEP IRA and solo 401k can offer to a small business owner, and or if you're self-employed and don't have employees, probably going with a solo 4K is a little bit more in the better interest of someone without employees. Whereas you have a few options here if you are a small business with 100 or less employees or little to no employees in the SEP IRA example. So keep some of this in mind as
you may have to choose what might be some of the more um, practical ways to contribute to a retirement plan. And some of these plans also have differences in how you need to register the paperwork. So there may be some complications, and I'm not sure exactly how complicated it can get with filing paperwork, but it's something to keep in mind.
I know that was a lot of information to take in, and I want to leave you with what I do in my retirement savings approach. So, I usually contribute the maximum $6,000 a year to a Roth IRA, or sometimes I split that also into a traditional IRA, depending on what I'm trying to invest in at that time. But either way, I max out the yearly $6,000 I'm allowed to contribute to either a Roth and or a traditional IRA. And then I try to get the minimum match required in a 401k plan as offered by my employer. So, whatever that minimum match amount is, I contribute at least that. And the only reason why I don't contribute more is because I don't really want to invest in some of these mutual funds. So, I try to do what I can to invest as an individual investor in individual stocks that I'd rather be invested in than deal with the capital gains or losses that I might deal with if I'm investing beyond a Roth IRA or beyond a 401k in then just everyday regular investing accounts, which are not tax advantage. So that's how I would go about it. But some folks might be interested in trying to catch up on their 401k contributions. So some people also like to max those out. I'm not at a place in my life where I try to do that, but I know plenty of people who do, and sometimes they tend to be people who are closer towards retirement age who might max out their 401k contributions. And there's nothing wrong with that. I definitely encourage, if you're comfortable investing in the 401k funds, that you go for maxing out your retirement plan options as much as you can and as much as you can afford, because some of those amounts can take a lot out of your paychecks if you're contributing a lot of it to your retirement plans. So if you enjoyed this video or learned something, please like and subscribe and leave any questions in a comment and I'll do my best to answer. Till next time.